Okay, good morning. Good afternoon. Can you hear me? Are you all ready? Corporate finance, this one. Are you all ready? Any response, please? Yes, very good. All right. All right. So today we'll talk about tutorial number 2. Today's tutorial will be revolving a lot around efficient market hypothesis. It's a very, very easy topic. Okay. So before I begin, I want to let you know efficient market hypothesis basically means in very simple form. I'm just telling you very short, very simple form. EMH or efficient market hypothesis basically means market reacted towards information. Okay, the market react towards information. All right, so let's see what does it mean by market react to information. All right, let's see. I prepared slides for today. Okay, because a lot of theory questions. So let's look at the question number 1 here. Define the 3 forms of market efficiency. So market efficiency is separated into 3 main forms: weak form, semi-strong form, and strong form. Okay, out of these 3 forms, there's only one form that could potentially give you abnormal return. Abnormal return here means huge profit. Okay, or unpredicted or unexpected huge profit here. Okay, only one of the form out of these 3 could give you this kind of abnormal return, and that kind of that form is semi-strong form. Okay, what is semi-strong form here, and how come with semi-strong form or during the market efficiency at the semi-strong form, how come can you earn abnormal return? Okay, so very simple. The only way for you to earn abnormal return out of these 3 forms will be on semi-strong form, and that also you must have internal news. Okay, trustable internal news. If not, you can't even make any abnormal return. All right. So in the semi-strong form, it's basically the market is efficient according to historical data, and the market price is also reflecting whatever public information available to the general people. So if so happen you manage to have internal news about the certain shares, stocks, or even market movement, you will have the advantage and you could make abnormal return. And this is the only form that you can make abnormal return. Whereas the other 2 forms is weak form and strong form. Weak form is when the market got no movement. Okay, the market prices are actually reflecting on historical prices only. Okay, because with historic prices, definitely you cannot make a prediction of future price, right? All right, it's speculation, pure speculation. So there won't be any abnormal return. Whereas in strong form is more towards a situation where the market already adjusted to whatever information available. So in other words, you're too late, already happened. Okay, so a strong form is already happened already, you're too late. Okay, by the time you realize it, it's already too late, already no more, already lose the chance, no more, don't have the arbitrage opportunity anymore. So this is basically the 3 forms of market efficiency. All right, very easy. We'll look through this many times. We'll go through it a lot of time later on into this tutorial. All right, I'll move on. Question number 2 here, they give you a list of statements here. Okay, so they ask you which of the following statements are true about efficient market hypothesis. Okay, so basically you need to understand what are the requirements and the criteria of EMH. Okay, to know more about EMH, of course, you can use the textbook. All right, and also your lecture slides. So coming to here, this first statement implies that perfect forecasting ability. So does efficient market hypothesis, is it true that it implies a perfect forecasting ability? Of course not. Okay, of course not. Because again, I want to emphasize the efficient market is basically how a market reacted towards a certain information. So there are no any forecasting ability there. In fact, they only given you a particular speculation according to the information, whether the price goes up or goes down roughly based on the what kind of information it is. If it's a impactful good information, then of course the stock price or the share price may go up. But if a bad news, then it will go down. So it does not imply any perfect forecasting ability here. Okay, because the prices are reflecting on all information. It does not only imply on a certain knowledge. So forecasting ability is definitely not being implied in the EMH. The next statement here, okay, EMH implies that prices reflect all available. Definitely, we have been repeating this since just now. So of course, EMH are supposed, okay, or in fact, is a theory, okay, or a hypothesis that says that the market are effectively affected by information. Okay, so prices will move according to information. Again, then they will explain it into the three forms, weak form, semi-strong form, and strong form. All right, the one that we already talked just now. So I won't cover in depth about that. So the next statement here will be, it implies an irrational market. Okay, think logically, yeah. Think logically. If if let's say the market prices are effectively or efficiently moved according to information. So do you think that why people are reacting towards the information? If the people are irrational, would they be reacting to the information or not? If they are irrational, they'll be buying as they wish, or they'll be purchasing as they want. And when you have purchasing, you will increase the demand. And when there's demand, it will push the price to goes up. Same vice versa. If there's a oversupply, okay, no one wants the particular shares, and there are too many people selling it in the market, it will push the price down. All right. So in the end of the day, all this decision to sell or to buy is being affected by information. So if people are being irrational, all right, they won't even react towards the information. They react as they wish. All right. So in this case, it's a false statement. Okay. It is a very rational market. All right. Because market participants or investors are very, very rational people. They will immediately make the decision whenever they receive an information, whether it's a bad news or good news, and that will reflect on the market prices. So this statement, they say, is an irrational market. False. Next, moving on. It implies prices do not fluctuate. How can be prices are fluctuating according to information? And they say it does not imply that, and it implies that price do not fluctuate. So this does not make sense at all. Okay, does not make sense at all. So keep in your mind, remember this, new information, price change. New information, the market price will follow accordingly. Whether it's going to go up or go down, depends on kind of information. So this is the keywords here. These are the things that you need to remember in the whole tutorial. Then you won't have issues about at all regarding this topic. Okay. Last statement here. It results from keen competition among investors. So the answer to this statement is true. Okay. What does it mean by keen competition among investors? Price movement, all right, will be moving according to information because there's investors, because there's competition between investors. Okay, everyone wanted to buy it when they receive good news. So when the buying increases, the demand increases, then of course the price will goes up faster. Okay, when the bad information come out, everyone want to sell it. So you are competing with other investor here to sell it off. So competition will drive the price to goes down further due to that incident. Okay, you will reach market efficiency faster. That means you will adjust it to a certain price which is relevant to the information. Then there won't be any more movement. You will be quite flat then. Okay, so far up to question 2. Do you guys have any questions so far? Anyone having difficulty understanding about this topic now? Come on, anyone? Are you all right? All 33 of you? Farah, so far so good. Very good. Jermaine also okay. The rest? I got 34 students, 33 students. But only 2 students say so far so good. The rest sleeping. No problem. Very good. Okay, more response now. So if anyone have any issues, please don't feel shy to ask me questions. please address it to me as soon as possible. Don't wait. Okay, don't wait until 1 week before your assignment submission or 1 week before your exam. You can't do any consultation and all. So please clear it off as soon as possible. It will be easier for you. Okay, and it's easy for me also because if I realize that you are not so good in that particular sector, I will emphasize more to assist you or to give you guys much more insight on a particular topic that you are weaker. So coming to question 3 here. Question 3, listen to this carefully. It's a case study here. More towards a case study, but not directly a case study. So Aerotech, an aerospace technology research firm, announced this morning that it has hired the world's most knowledgeable and prolific space researcher. So this space researcher firm just announced to the world that they got some of the best people in his company, in the team of their researchers. So before today's Aerotech stock had been selling for $100. Assuming no other information received over the next week and the stock market as a whole does not move, what do you expect to Aerotech stock? So logically speaking, the moment you know that they give this kind of announcement, they got one of the best group of researcher researching in the company which do aerospace research, it is the very good news. It is definitely a very, very good news. So because of the good news, the price will definitely goes up. Okay, the price will definitely goes up. Very easy. So let's look at the second part. Consider the following scenario indicates market efficiency. Consider the following scenario. Which scenario indicates market efficiency? Which do not, and why? So there are 3 statements here. So you answer me. You guys answer me. Which of these 3 indicates market efficiency and which one do not? Come, anyone, volunteer first before I start calling names. Come on. Participate together, no right or wrong. Based on your judgment, based on market efficiency that you know so far, which one will most likely happen? A, B, or C? Come. Come on. Alvin say B. The rest? Alvin say B. What about the rest? A. Azari say A. Fangen say A. Some more? A. B from Eugene. Some more? Any more A? More A coming? No C. Anyone think C? A lot of A. Okay. Good that a lot of you participated today. I'm very happy to see that. So let me tell you, a lot of you choose A. I would like to know why you choose A. It's very confusing here. Okay. C. Jai say C. Okay. Jai, why C? Why C? Jai?
Wait. Let me think of my answer first.
Can. I'm interested to know because you choose C. Is it because I highlight in red color? We give Jai some time to react towards this question. Okay, I see a lot of A's answer. 2 students say B, if I'm not mistaken. Only 2, right? Eugene. Oh, Hui Jun also say B. Alvin, 3 students. 3 students choose A, 3 choose B. Most of the majority choose A. Jai chose C. So Jai, no need to think so hard. Just tell me what inspired you to choose C. What makes you think is C? Hmm?
Uh,
The first thing that comes
okay,
to mind.
it's
Yeah.
A.
Why A, not C?
I think it's A.
Why not C?
No, because the market price should, no, the information should reflect the market price
Okay.
quickly, but then usually stock prices don't remain the same for very long.
Mhm. All right. So Jai choose A. Okay. So let me tell you all. I put this. I highlight it C. So why no one choose C? Okay. So if you choose A, very simple. Let me tell you why you are wrong. Let me tell you why A is wrong. Read the statement properly. The stock price jumps to 118 on the day of the announcement. In subsequent day, it floats up to 123. Then it falls back to 116. Does it reflect the market is efficient towards information or not? Okay, the answer to this is no. Why no? I know from A, you look at it, it's very common that a lot of people will think the answer is A because it seems very convincing. Oh, the price fluctuate up and down. Yeah, then after that, it balanced up. It adjusted back to 116. Okay, so that is the scenario that most likely will happen in a real life experience. In fact, this is what will actually happen in real life also. So the problem here, there's a mistake in the statement here. Okay, stock price jumps to 118, makes sense. Overbuying, overvalued. Okay, normal. Jumps to 118 on the day of the announcement. In subsequent day, it floats up. Why? Why wait until the following day it floats to 123? Why it still can go up on the second day? This is the problem here. So this is already not efficient. Okay, if it says the stocks jump, the stock's price jumps to 123, stay afloat at 118, and then falls back to 116. That one, okay, acceptable. Okay, but this one jumped to 118 on the same day. Then on the following day, only it floats up to 123. What make it float? Why people still buying on the second day? Then only it falls back to 116. So this is where the statement having problem. It's supposed to happen spontaneously during the period. And yeah, it's very normal for stocks to overshoot, share price to overshoot a certain level, adjusted back to undershoot a bit, then adjusted back to a equilibrium level, which is the price is supposed to be here on 116. Okay, but A, the mistake here is because it takes subsequent day to float. That is already inefficient. C is actually totally out. The stock price gradually climbed to 116 over the next week. It take one whole week to adjust to the market. Where got such thing one? Okay, the moment Elon Musk make the Twitter announcement, what happened to the stock market and what happened to the crypto market? Straight away, price go hoo ha, chaotic rises, chaotic fluctuation already. Due to his one Twitter only. All right, so there's no delay in response. Usually, people are very effective on the information given and are very reactive towards it. So the correct answer here should be B. The stock's price jumps to 116 and remain at that level. So it struck high. Of course, there's no minor adjustment, but basically it was strike to the 116, and then you can see the buying and the selling started to slow down and it stays there. So this shows that the market is efficient. The market is reacting towards information, okay, and push the price to its supposedly value. Can see the difference now, can see the flaws here, or the loopholes of each of the statement here. Okay, so please keep this in mind. Very good that most of you already have an idea that EMH means, all right, price sensitivities towards information. Very good. So let's move on. Question 4 here. A famous economist just announced in the Wall Street Journal his finding that the recession is over and the economy is again entering an expansion. So he's telling the world now, no more recession already, economy is going to be stable back. Assume market efficiency. Can you profit from investing in the stock market after you read this announcement? Can you still make money, after this announcement is being made? Definitely no. Okay, definitely no. Because the moment this announcement is being made, the market is already in strong form. So when you're in strong form, the price is already at peak. There's no potential for you to make any abnormal returns. So the only way for you to make abnormal return is before the economists announce it, you already get direct information. Maybe this economist is your friend. He tell you, okay, tomorrow I'm going to make this announcement. Then you must already take action. If you take action at that point itself before the announcement, yes, you will gain abnormal return. Otherwise, no. Okay? Can. So anyone have any questions so far? Boys, girls, are you all having questions or are you all okay? No. Very good. So I see one no, I assume all no. Huh? So I'll move. Looking at question number 5 here. They tell you, suppose that the market is semi-strong form efficient. That means the potential to earn abnormal return. So can you expect to earn excess return if you make trades based on the 3 situation below? So they give you 3 situations. Can you make abnormal return from this situation or not? Situation number 1. Your broker's information about record earning for a stock. Come on lah. Record earning basically you can get from annual report. This is something historical, something existing to the public. So definitely no. Definitely no chance to make any excess abnormal return. Number 2, rumors about a merger of a firm. So very important. That's why I put there a maybe. Maybe there. Very important to know where's your source of information. So if your rumor came from you visiting the market, a bunch of uncle and auntie sitting by the coffee shop and telling assumption of these kind of things, then those might be real rumors. Okay, those might be real rumors. You might want to be more careful dealing with this kind of rumor. Okay, it might just be one of the uncle or auntie woke up on the right side of the bed having a huge dream about whatever stocks and then start babbling and mumbling in the coffee shop. Okay, but there's still a chance of you that the rumor is right because maybe it's a 50-50. Maybe the auntie's son is working in that firm and telling that to the mom already. So the chances there from this rumor is a 50-50 here also. Okay, that's why it's a maybe. But if you get a direct information from the merging firm itself, from the internal people itself, that one is very reliable. So you're definitely gonna make a excess return. But if you're going to get the information from random people that you eavesdrop, then that one, 50-50. Okay, 50-50. The last statement here. Yesterday's announcement of a successful new product test. Already yesterday. Okay, information already over. So, it does not work. You will not get the benefit. Clear? Anyone not clear so far? I see the chat there, there's no response. So I assume all of you are doing pretty well. Jermaine say clear. Very good. Very good to be clear. Okay. So now we'll go through several objective questions lah. Okay. Today is actually a very short tutorial. We'll go through several objective questions. So let's look at the question number 1 on the objective MCQ. An efficient capital market is one in which, so very simple, the answer going to be E. Security prices reflect available information. This is the whole EMH. Okay, so the efficient capital market is one in which the security prices reflect the available information. Straight to the point. Question 2 here. According to the efficient market hypothesis, financial market fluctuate daily because why the financial market fluctuate every day? Okay, because they are continually reacting to new information. Okay, so that's why this shows that EMH is existing because the markets is fluctuating according to new information in a daily basis. Okay. 3. Which of the following tend to reinforce the argument that the financial market are efficient? So which one shows that the explanation of EMH? So number 1 here, Information spreads rapidly in today's world. Yeah, this is why the efficient market hypothesis is so functioning well, because information is available very fast. Okay, it's just one click away. The internet make things so fast. Okay, a Twitter will be reached to the whole world in less than a second. The moment you tweet it, the whole world got it. Back then, they don't have internet and such. Information don't spread so rapidly. Number two, there is tremendous competition in the financial market. Definitely, so many competition. The banks, the financial institutions, the independent investors, so many competition. Market prices continually fluctuate. Yes, market prices need to fluctuate because based on the EMH, and market prices react suddenly to unexpected, of course lah. Okay, price fluctuating and they fluctuate due to news. So the answer to this is E. All of the statements are correct. Okay, are actually reinforcing the argument of financial market efficiency. Looking at question number 4 here, the abnormal return in an event study is described as abnormal return means huge earning, okay, sudden earning. So this is basically the excess return earned on the day of announcement for the stock. So the particular day, suddenly it strike price, okay, so you have the excess return earned on the day of announcement for the stock, and this is called abnormal return. Okay, abnormal return, huge profits. Next one. This question is very subjective lah. But based on your textbook, the answer is all of the statement is true. But if you want to talk about current situation, some of it is debatable. Okay, so for number A, in efficient market, a stock price should change with the arrival of new information. This is still the same. This is basically the EMH itself. Okay, B, every stock returns are higher in January than other months. So usually this is the case. After the December holiday, or the winter holiday, or the winter break, usually stock prices, all right, tends to have higher return in the month of January. But of course, there might be some other debates or discussion or objection regarding this statement, because this year in 2021, April is having the most highest return, okay, in the year so far. C, studies by Pharma and French and others find that return of high book to market stocks. What is high book to market stocks? Okay, book value means basically your recording, okay, your actual price of you recording, how much you worth, and so on and so forth. So if let's say your high book to market stocks means your book value, okay, the value of your the book value of a certain thing is actually higher than the market stocks, than the market evaluation. So in other words, this shows that it is an undervalued stocks. Okay, is an undervalued stocks. The value in the market is not as high as the value from the accounting perspective itself. So maybe based on your earning and profit and so on and so forth, this company is supposed to do much more better because the book value is very high compared to the market value. In the market, it actually only worth that much, so it's not valuable. Okay, so they're telling you this is undervalued stocks. So why? They have, based on the research from Pharma, French, and others, find out that undervalued stocks will give you higher return compared to overvalued stocks, based on the efficient market hypothesis. Why is this true? Very simple. Think logically. Yeah. When you find out something is cheap, what do? You will buy, right? Makes sense, right? When you go to the mall, you see something, wow, there's sales. This is cheap. Nike is selling at $15. This is very cheap. LV is selling at $100. That's super cheap. I must buy it. Okay. So when something is undervalued, people will want to buy it. Okay. People want to buy it. When people buy it, what happened to it? the demand for it increases, and this will push the value of the items or stocks, and then it will give you a higher return. If something is too expensive, what do you do? Okay, something too expensive, the most is you don't buy only one. Okay, when something is expensive, you don't buy. Okay, or you don't do anything to it. All right, or if you have it in hand, you might want to sell it also. Okay, and but the reason is when it's high, people don't buy it. So this does not generate more income compared to an undervalued stock. So an overvalued stock, of course, it will be adjusted back, it will drop, but then it won't be giving a higher return compared to an undervalued stock. When someone knows something is cheap, people be rushing there to buy, and very easily they can push it backwards. And then they give you a higher return also due to that because the demand increases. All right, the demand for the product increases, you will increases your gains also. Can agree, disagree? So according to the textbook, all of these statements are true. But if you're according to reality, maybe some of you disagree with statement B. So satisfied with the answer, or anyone thinks that there's any objection? Hmm? Anyone have any objection or disagree? I think no questions, right? No one responded to me. Okay. Chi Yong say no, no issues. Very good. So no response, that means no issues, okay? Then I'll move on to the last part of today's tutorial, which is a calculation problem. All right. Look at this question given to you here. It's a calculation question. So they want you to find CAR. Oops. They want you to find CAR. Okay. So let's read. What is this? Delta, United, and American Airlines announced purchase of planes on July 18. So July 18. This is the announcement day, day 0. So day 0, after announcement, day 1, day 2, day 3, day 4. Before announcement, minus day 1, minus day 2, minus day 3, minus day 4. Okay. 12th of July is 4 days before announcement. That's why it's minus 4. Then moving oven on 18th of July is the announcement date. Okay. Announcement date. 18th of July. Then after announcement, 1, 2, 3, 4 days again. Okay. So given the following information, calculate the CAR for these stocks as a group. Graph the results and provide an explanation. All of the stocks have a beta of 1. That means all have the same risk level. So all equal lah. So no percentage all. Okay. So now, very simple. They want you to find CAR. To find CAR, you need to find the abnormal returns of each of these company first. How to find that? Very simple. To find the abnormal return of each company, abnormal return is equals to company return minus market return. Okay, company return minus market return. How? Look at delta first. Look at delta. Company return is negative 0.5. Negative 0.5 minus negative 0.3 become negative 0.5. Okay, negative 0.5 minus negative 0.3. Negative become positive. So negative 0.5 plus 0.3 become negative 0.2. Make sense or not? Make sense or not? Negative 0.2. Simple maths. Okay? Minus negative 3. 3 days before announcement. 0.2 minus 0. You get 0.2. 0.7 minus 0.5. You get 0.2. Negative 3 minus negative 0.5. Become positive 0.2. Negative 1.1 minus negative 2.2. 1.1 minus become positive, become 3.3. Announcement date 3.3. Negative 7 minus negative 0.9 become positive 0.2. Negative 1.1 minus negative 1 become negative 0.1. 0.5 minus 0.7 equal minus 0.2. 0.1 minus 0.2 equal negative 0.1. Okay, this is for delta. Repeat the same action for united. Negative 1.1 minus negative 0.9. This will give you negative 0.2. Negative 1.1 minus negative 1 equal negative 0.1. 0.2 minus 0.4, negative 0.2. 0.8 minus 0.6, 0.2. Negative 1, 0.1 minus negative 0.3. This one is become 0.2 again. 1.2 minus 1.1 become 0.1. This one becomes 0. This one becomes 0.1. This one becomes negative 0.1. Repeat for American now. 0.3 minus 0.5 is negative 0.2. 0.6 minus 0.4 equals 0. Sorry, no negative, 0.2. This one is 0. Negative 0.4. Negative 0.3 minus negative 0.2, negative 2.2. This one will become 1.9. 0. 0.1. Negative 0.2. Negative 0.1. So all these AR that you get for Delta, United, and American, you shift to the next table here. So you see, days of announcement. Day 0 is 18th of July. This is your AR for Delta, AR for United, and AR for American. So having all this AR, you want to sum it up together. Negative 0.2 plus negative 0.2 plus negative 0.2 equals negative 0.6. 0.2 plus negative 0.1 plus 0.2 is 0.4 minus 0.1 equals 0.3. 0.2 minus 0.2 plus 0 is equal to 0. 0.2 plus 0.2 is 0.4 minus 0.4 is equal to 0 also. 3.3 plus 0.2, 3.3 plus 0.2 is 3.5 plus 1.9 is 5.4. 0.2 plus 0.1 is 0.3. Negative 0.1 plus 0 plus 0.1 is 0. Negative 0.2 plus 0.1 minus 0.2. So this is negative 0.4 plus 0.1 is negative 0.3. And lastly, negative 0.3. So once you get the sum, because there are 3 companies, so divide 3 companies. Take the sum divided by 3 company. Negative 0.6 divided by 3, negative 0.2. 0.3 divided by 3, 0.1. 0, 0, 0, 0. 5.4 divided by 3, 1.8. 0.3 minus 0.1. 0.3 divided by 0.1. 0.3 divided by 3. You get 0.1. 0 divided by 3 is 0. Negative 0.3 divided by 3 is negative 0.1. And lastly, also negative 0.1. So basically take the sum. This sum divided by 3 because there's 3 company. Okay. Once you got the average abnormal return, your AAR, you want to find your CAR. Find CAR so you can plot it onto the graph. So when you see CAR, very simple. Okay. Negative 0.2 plus 0.1, you get negative 0.1. Negative 0.1 plus 0, negative 0.1. Plus 0 again, negative 0.1. Plus 1.8, you get 1.7. 1.7 plus 0.1, 1.8. Plus 0 again, 1.8. Minus 0.1, 1.7. Minus 0.1, 1.6. Okay, so now you already got all this information. They want you to draw a graph. So to draw a graph is basically x-axis and y-axis. Okay, so how your graph looks like? It's gonna be like this. You see, this is your CAR. This is your day from announcement. Day minus 4, how much? Negative 0.2. Then day minus 321 is 0.1. Okay, 0.1, 0.1, 0.1. On the day, on the day of announcement is 1.7. Shoot up. On day of announcement, 1.7. After announcement, drop to 1818, 1716. So you count 18 flat, 17, 16. You go back down. So you see, before it's actually quite flat. After also it's actually quite flat. Only the jump is over here. The jump is in the middle. Okay, is in the middle when the purchase happening on time 0. Okay, to explain on this, you just need to say the market react favorably to the announcement. So that means the announcement make the market respond to it and it shoot up. The market react only on the day of announcement. Okay, before the event and after the event, the abnormal returns are going back to flat sign. All right, so this definitely shows the market efficiency. Or this definitely define the market efficiency. Okay, so any questions so far until here?